Good afternoon, Professor. My name is Levi Tennyson. Today, I will be presenting my 5-year financial ratio analysis comparing Deere and Company, aka John Deere, and Caterpillar Incorporated, aka CAT. These two companies are direct competitors in the heavy machine manufacturing industry, and both have long histories, global reach, and major financing divisions. I will be walking through 8 key financial ratios to evaluate profitability, efficiency, leverage, and overall financial health to determine which company appears to be stronger long-term investment. Let's first dive into the companies and get a quick background of both of the companies. John Deere was founded in 1837 and is widely known for agriculture, construction, and forestry equipment. Deere also operates a large financing firm, Deere Financial, which significantly affects its balance sheet, which you'll see later on in the presentation. Caterpillar, founded in 1925, is the global leader in construction, mining, and energy equipment. CAT also runs its own financial service division, but maintains a different financial structure compared to Deere, which you will see and will be explained later in the presentation. Both companies operate in the same industry, which makes their financial comparison especially meaningful. The data and ratios that I used. For this analysis, I used financial statement data pulled from the Wharton Research Database using the Compustat North American database. I analyzed the most recent 10 years of available data, covering fiscal years 2015 through 2024. The ratios I calculated fall into 3 major categories: profitability, activity, and coverage. The 8 ratios used included profit margin, return on assets, return on equity, earnings per share, asset turnover, inventory turnover, debt to asset ratio, and the times interest earned. Together, these ratios give me a complete view of each company's performance, risk, and long-term financial strength. Moving on to the data. Starting with profit margin, we see that John Deere consistently shows steadier margins over time. Deere's profitability gradually improves, especially from 2020 onward, which is very important for an investor talking about an investment's risk. Caterpillar's profit margin is more violent. The dips early in the period come from restructuring activities and cyclical downturns in the construction and mining market. Overall, Deere demonstrates stronger and more reliable profitability, which is a key indicator for investors looking for long-term investments. Moving on to each company's return on assets, or ROA. This measures how effectively a company uses its assets to generate profit. Here, Deere again shows a smoother upward trend, particularly after 2020. Caterpillar's ROA fluctuates much more dramatically, ranging from negative or near zero in 2016 to strong peaks during recovery years. This tells us that Caterpillar is more cyclical and dependent on industry conditions, while Deere provides more consistent asset performance. Consistency in ROA generally means lower operational risk for investors, which would be a great sign when choosing what to invest in. Now moving on to the return on equity. This shows how much return a company generates for its shareholders. Deere posts a strong and stable return on equity across the entire period. It climbs significantly in the years where earnings are strong, and it rarely drops sharply. CAT also shows impressive increases, especially during the rebound years, but the trend is less stable and more reactionary to external cycles. Overall, Deere provides more reliable long-term returns to its shareholders, which is a major factor for investors. if you couldn't guess that. Now moving on to each company's earning per share. Earnings per share is one of the most important valuational measures. Deere's earnings per share growth is extremely strong. It rises steadily, jumping sharply after 2020 and peaking around $36 per share. This reflects strong earnings expansion and effective cost management. Caterpillar also shows growth, but the increase is not as steep or consistent as Deere's. This chart highlights that Deere has stronger long-term earnings momentum, which plays a role in future valuation and investors' confidence. Now on to each company's assets turnover. This measures how effective each company generates revenue from its asset base. Caterpillar consistently outperforms Deere in this category. CAT generates more revenue per dollar of asset and maintains this advantage across all 10 years. This is one area where Caterpillar clearly demonstrates stronger operational efficiency. And now moving on to each company's inventory turnover. In terms of inventory turnover, Deere consistently stays higher than Caterpillar. This means Deere sells through its inventory faster, reflecting stronger demand flow and more efficient inventory management. Both companies follow a similar trend over time, but Deere stays ahead in total numbers. This is a meaningful advantage for Deere because high inventory turnover often correlates with better cash flow and better operational control. Now moving on to each company's debt to asset ratio. The debt to asset ratio reveals how leveraged each company is. John Deere carries much higher leverage due to its financial services segment, which significantly increases its liabilities. Deere's ratio consistently stays around 0.75 to 0.88. Caterpillar, on the other hand, maintains an extremely low debt to asset ratio, often under 10%. This indicates a far more conservative financial structure. This makes Caterpillar much less risky from a leverage and solvency perspective. CAT is better positioned to handle downturns without financial strain. Now moving on to times interest earned. Times interest earned measures a company's ability to cover interest payments without operating income. Caterpillar shows stronger interest coverage in most years, especially after 2018. Deere's interest coverage increases over time but remains below Caterpillar's for much of the period. This means Caterpillar handles its debts obligations more comfortably, adding to its lower risk profile. Now, what does any of this mean? Let's put it all together. Each company has clear strengths depending on the ratio category. John Deere excels in profitability, long-term earnings growth, and inventory management. Caterpillar leads in asset efficiency, debt stability, and interest coverage. Both companies perform well, but in different areas that apply to different types of investors. After reviewing all of the data, my final investment recommendation is John Deere. Although Caterpillar is less leveraged and financially safer, Deere consistently outperforms in profitability, shareholder return, and long-term earnings growth. Deere's ability to maintain steady margins, deliver strong return on equity, and generate rapid increasing earnings per share makes it a stronger long-term investment opportunity. Caterpillar offers lower risk, but Deere provides greater long-term value creation. For these reasons, I believe that John Deere would be the smarter long-term investment. Thank you for listening to my presentation, and again, my name is Levi Tennyson.